Welcome back to another video, everyone. My name is Adam. Today, I'm excited to share with you 4 stocks to buy in April. These are stocks that I think could be good for either short-term swing trades or even holding over the long term. And I'll go over my price target for each one, as well as which stocks I own. The first one is PaySafe. I recently added some shares of this company, and I think my cost basis is around $13. And it just recently now trades on the New York Stock Exchange, and it reversed merge with BFT, one of Bill Foley's SPACs. It focuses on digital wallets, eCash, software vendors, and iGaming. If we look at their PowerPoint presentation, their key sources of revenue can be seen right here. Sometimes it's kind of hard to understand exactly where they get their revenue from. So fees are charged for consumer deposits into wallet, money transfers between wallets, money transfers to merchants, money transfers from merchants to consumers, et cetera, et cetera. So you can and there's foreign exchange transaction fees for their eCash portfolio, fees charged to merchant on distribution fees paid to distribution partners, and then maintenance fees. And finally, for processing, so acquiring fees charged based on percent of volume, gateway charged based on a per transaction fee, and additional fees for value-added services. And here you can see their take rate for each one. So I really like this company. One, it's already a cash machine. It's growing revenue by quite a bit, and it's processed over, I think, 1.5 billion transactions just in 2020 alone. Okay, so this is a pretty high margin company. And now, as antitrust cases are mounting on stuff like Visa and MasterCard, and the era of fintech is arguably here, I think PaySafe is definitely a clear winner in this field. Okay, so you can go over their investor presentations, you can go over their fundamentals, but I really like this stock for what it has to offer in the long term. Okay, in the short term, if this stock goes to around $20, I might be tempted to sell. But until then, I think I'll just keep adding or even just holding to this position. One concern I do see is rising interest rates may limit how much this stock will move in the short term. And there's kind of a reversal of the market, and a lot of money is moving into more value-oriented stocks rather than tech-focused stocks such as PaySafe. Okay, but overall, I think with the growing field of iGaming, of which PaySafe is actually a dominant player in, I think this could be a very good company. And even at $14 and change, I think it is a very, very safe company to bet in. And this company is just has had strong volume growth historically, and has consistent revenue growth. They're expecting compounded annual revenue growth of about 10%. And 2021, for example, they're going to do about 1.5 billion in revenue. Okay, they're also offering new features, and they have a bunch of subsidiaries such as PaySafe's Neteller, and they launched their customer rewards program. So I like how they're a highly innovative company, and Neteller, I believe, allows collecting of points. So yeah, it's a loyalty program that rewards customers for choosing to pay with their digital wallet, as launched today in over 100 countries. So I also like, of course, that this company is global. Okay, and it's pretty easy to scale their services. And the hardest part, I think, is actually getting the software, getting the security needed. Okay, so again, PaySafe is definitely one that's on my watch list and that I'll be adding to on any dips. And again, if it goes to around $20, I'll probably sell out of my position. The next one is, again, a bit more of a risky stock, and this is Churchill Capital Corporation IV, and this is the company, the SPAC that's going to merge with Lucid. Okay, I think it rose to crazy heights when it was trading at around $58, and then it's come down back to earth by over 59%. I added to this stock when it was around $21, and now it's back up to $23. Again, in the short term, if it goes to like $30-ish, I'll be adding to my position. And I think this signal downwards, where you can see this is like a typical head and shoulders movement. Here might be one shoulder, that's the head, and that's the other shoulder, and then back down again. But I think it's kind of reached a plateau here, and I think it might even turn around. One of these reasons might be, of course, Biden's infrastructure plan. So this will help electric vehicles in a massive way, because he's going to at least try to give funding to things like building up electric vehicle charging stations. He's going to also add funding to electric vehicles in general. So again, Lucid as a luxury EV maker, I think will stand to profit from this. Okay, but again, since this is seen as not only as an auto manufacturing company, but also as a tech company, rising interest rates could hurt this stock and tech stocks in general, because rising interest rates basically discount the future value of tech stocks earning, okay, because they generally tend to earn quite a bit, okay. So you have to be careful with a stock, but I still think, you know, it's sitting at a 59% premium over where it was in February, and I still think it has been beaten down, especially since tech stocks have been beaten down as of late due to the chip shortage, etc. Okay, but if you look at the car, this is a company that I think is not necessarily trying to compete with Tesla directly, although it is focusing again on the EV segment of the market, and it does have pretty nice growth potential. I mean, like, look at this car, okay? This is what post-luxury is all about. You know, not about necessarily the hedonic, pleasure-seeking reward processes, but more just like you want a luxury car that's environmentally sustainable, and this is the world that we're getting into, okay? So the interior looks fantastic. I mean, it's a bit of a pricey car, but there's always going to be a niche consumer market for luxury EV makers, and I think the Lucid Air can capture a significant majority of this market. Even if you look at stats though, it makes all its batteries in-house, all its tech is basically in-house, and it actually has a higher range. The Lucid Air has a higher range than the Tesla Model S. Okay, so this is pretty damn impressive, okay, and even compared to other more luxury brands like the Jaguar I-Pace, this EV only has 234-mile range. So it has superior stats to even Tesla. I mean, sure, it comes at a steep price tag, but people, I believe, will be willing to pay for this, and that's why I own this company. And again, this is a more long-term hold, but if there's a fluctuation to, let's say, like $35, I might have to trim or sell out of my portfolio just to take in the profits, and I've already done that. I've actually invested when it was $18. I wrote it up to $56. I sold there, and I made a nice sum of money. The next one is Qualcomm, okay? And I mean, it may seem a bit expensive for a semiconductor company, a PE ratio of 23.53, and you can see over the past year, it's gone up by 111%. I actually bought in when it was around $120, and so I'm sitting on a pretty nice profit, and I'm still holding for now. One of the main reasons is because, of course, you might have heard of the chip shortage. So not only do laptops use chips, but also cars, okay, especially electric vehicle smart cars that are using this automated driving technology, okay, so so-called like the robo-taxi network that's sort of coming up. It's heavily dependent on chips, okay, so I believe Qualcomm is an innovative semiconductor company, and their products are highly, highly needed. Okay, and I think they're a pretty innovative company. They also pay out a dividend of about 2% as of right now. I mean, even if we're looking at the forward P 17, it's still kind of expensive, but chips are one of the main things that's going to drive the tech sector growth forward. Okay, and again, I don't think this will be as highly impacted as tech stocks due to for rising interest rates. Okay, and also Biden's infrastructure plan also wants to add funding for making chips in the US, okay? And this is actually an American multinational corporation. Okay, it's headquartered in San Diego, California, so I think Qualcomm could stand to benefit from this. All right, and I mean, I still think that the fundamentals are pretty attractive. The last thing I want to talk about is a safer play, and one that I've actually been adding to recently, and this is Kirkland Lake Gold. Okay, so ticker symbol is KL. It trades on the Toronto Stock Exchange as well as on the New York Stock Exchange. The reason I really like this stock is, of course, as a safe haven for the rising Treasury yields, okay, and of course of the fears of inflation. So if you look at Kirkland Lake Gold, you'll see that it has actually been absolutely beaten down over the past 6 months, going from, you know, 67 US dollars, even like 70 US dollars right here, all the way back down 39%. Okay, so I am sitting at a bit of a loss on this stock, and I think it is such an undervalued play. Usually the dividend yield on these stocks is around like 1%. This stock has a dividend yield of 2.13% as a gold company. And I mean, they have had like no issues whatsoever. Their PE ratio is 12. Okay, which is incredibly low, and that's just the trailing 12 months PE ratio. Okay, I think their forward PE ratio is around like 10, which is really, really low for a gold company. And I think the stock has been unnecessarily beaten down and will stand to rise based on inflation concerns and interest rate concerns. So look at here, this is the Treasury yield index. So what this means is this is the yield you'll get from the bonds, and it's just an index basically. In August, when everyone wanted bonds because those were a safe haven, but then when people start to sell off bonds, as we can see by an increase in the yields, so we can see the yields spiked from August all the way to April by a tremendous amount. Bonds look less attractive when inflation is rising, and that's why the yields are going up, because people are selling off bonds. Okay, and the last thing is, of course, I mean, it's good to look at what people who are highly intelligent and knowledgeable in the market are. And I know Bill Gates is becoming more of a controversial figure, but he sold out of Alibaba Group fully. Okay, and I mean, this might be due to concerns in China, but also due to, of course, the concern that tech will fall once interest rates rise. Okay, he also reduced his holdings in Berkshire Hathaway. The only position that he added to was Schrodinger, of which I added some shares. He also reduced his shares of Apple by 50%, of Amazon by 50%. He sold out of Boston Properties. He reduced his holdings of Google by 50%. So this shows to me that, you know, it might be time to start to trim some positions, and he might think some sort of semi-correction or crash is coming. So that's also why I like Kirkland Lake Gold, is because it's generally a hedge against that. So that's all I have for you today. Make sure to smash the thumbs up button and subscribe if you haven't already. I also want to add that if you want to join my Discord, I talk about my buys and sells, as well as we have an oil tanker channel, a general channel, and it's growing. So definitely feel free to check out the free link in the description below. And if you're in Canada and you're looking to buy and sell stocks with zero commission, definitely check out Wealthsimple. That's where I do more of my smaller plays, as well as my bigger plays, because I avoid like a $10 fee that I have to pay with TD. Okay, so if you have any questions or concerns, let me know down below in the comments. You can also message me. I'll see you next time. And until then, stay safe, take care, and I love you all.